Hello, welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is investing in emerging markets. Now, there's probably more differences today amongst the individual countries in the emerging market spectrum than there has been since the late 90s, right? It's really a case of the haves versus have-nots right now. And that's what I want to talk about today. Now, why the interest in emerging markets, right? Well, there's been a lot of interest in foreign investing with the weakness of the dollar, right? The dollar for the last couple of months, of course, has been particularly weak, and that's caused gold prices to rise, and it's also caused people to think about investing outside of the U.S. But we need to be careful when we do that. So let's jump to the chart here to start with. Here we're looking at a number of different equity indices from around the world. All right, what I want to focus on here, start with the white bar. These are 1 year forward PE ratios. All right, so the NASDAQ has a forward PE of about 40 right now. Very, very expensive. The S&P 500, 26. Okay, both of those are expensive. Jump down here to the bottom, for instance. China has less than 16. All right, that's what we want to focus on today. Now, you'll also notice most of Europe tends to be in the low 20s. All right, so these European numbers you'd want to compare to the S&P 500, the 26 number up there. Now, Europe always trades cheaper. Is it considerably cheaper today? No, not really. Not really. The discount is pretty much in line, right? It is cheaper. There's no question about that. But like I said, it's always cheaper. The big one I think right now we want to focus on, though, again, is down here at the bottom. Down here, the second to last line at China. Now, you notice on a year-to-date basis, these are dollar returns over here in this column, the yellow box. On a year-to-date basis, China is up about 16%, without including dividends, right? These are not total returns. These are just price returns. So China's up 16, NASDAQ is up 26, and the S&P is up a little over 5. All right, so the difference between China and the NASDAQ. Of course, China has a lot of tech-heavy influence, and the difference between China and the NASDAQ is something that you might be getting interested in. So that's what we want to talk about today. There are some important differences between the two. Now, of course, there's political risk, right? Huge political risk. And right now we have, the main political risk, the geopolitical risk of importance is China and the U.S., right? Both front and center. And of course, the sanctions being put on Huawei and TikTok, ByteDance, possibly even Tencent, right? These are in the news every day. We got to think about that. We have to think about that. But the reason to think about EM going forward is in the past, it was sort of the U.S. versus the rest of the world. Going forward, I think we're down to a two-horse race. It's U.S. versus China, right? Those two markets are just swamping everything else. And that's where our primary focus has to be. So if we think about investing in EM, one way to do it, probably the most popular way to do it, is to buy the EM basket. All right. And the most popular passive ETF in that spectrum is something called the EEM. All right. EEM. And I want to talk about that for a second. Take a look at the weights in that index, the EEM country weights here. Over 40% of that index is now China and Hong Kong. All right. Hong Kong, we're talking about the H shares here. Hong Kong is actually a developed market itself, but the H shares, the Chinese company that list in Hong Kong are referred to as the H shares. So China and Hong Kong is over 40%. Then Taiwan at 12, South Korea at 11, and everything else. Now, the important thing is these three make up about 2/3 of the index. South Korea, Taiwan, and China. 2/3 of the index. Right? That index is never, to my knowledge, been this lopsided. Right? When you invest in EEM, 2/3 of it is in 3 countries. Right? That is really amazing. That is something to think about. But that's also a blessing. As well as being a curse, it's also a blessing. Now, let me explain that. Let's take a look at some performance numbers here, and I'll explain that. Now, part of the interest for investing in EM, of course, is during the month of July, look at these EM numbers here, right? EM on the back of dollar weakness had some huge numbers in the month of July. In August, yeah, some of it's continued. Not so much for Brazil and Turkey, but some of the, most of the other ones, it's generally continued. What I want to focus on here is the year-to-date numbers. Let me blow that up here. That's the same chart we had in the lower right-hand corner, just blown up here. So the overall EM index, the one that EEM ETF tracks, is down 2% of the year. Again, remember, down 2 compared to being up 5 for the S&P and up 26 for the NASDAQ. Again, just using round numbers. Okay, you say, how can it be down 2? Well, China's up 15 and Korea is up 10. And South Korea, China's 15, Taiwan is 10, and South Korea is just up 1. Now, everything else, all the other major countries are below water here, and significantly below water, right? This is a problem, right? India has some issues they're dealing with, but these other countries, these are the countries I was talking about that have very important structural issues that they're dealing with. That's why we're getting the big differences right now within EM. Sort of these are the have-nots, and up here are the haves, right? Those that are doing a better job at managing things. Okay, so again, the overall index was only down 2. And remember, the reason it's down 2 is because 2/3 of the basket is in these top 3. These top 3, right? They are driving everything right now. Outside of that, the other third is sucking some serious wind here. Okay, now that is something to think about. That is really the problem. So if you invest in the EEM basket today, the EEM ETF today, 2/3 of it still looks pretty good. The other third, not so much. All right, so on the one hand, you can say the good news is, when you buy the basket, the market cap weights are kind of correcting itself, and 2/3 of it's pretty good. The way I'd look at it is if you buy the basket today, you're still getting 1/3 of the stuff you probably don't want, right? The stuff with some very serious problems. So you probably want to think about some country funds or some country ETFs, like the MCHI. MCHI is a popular ETF for China only. China only, right? If it's 40+% of the overall index, maybe you want to focus yourself in China only. Another thing, Taiwan, you got to remember the largest company there by far and away is Taiwan Semiconductors. All right, so do you really want to invest in all of Taiwan, or do you just want Taiwan Semiconductors? That's another thing to keep in mind when you head down the path of thinking about country funds. But right now, you probably want to try to avoid some of these problem areas. Now, again, they're only 1/3 of the basket, but they are problems, and those problems are going to take a long time to iron out. And I would suggest you think about avoiding those for the time being. Okay, so that's our message for today. If you found it helpful, hey, help a fat guy out, man. Please subscribe to my YouTube channel. It's called Rich Insights here. Help a fat guy out if you would. Or follow me on LinkedIn. We have a number of daily posts that are called Fat Stackonomics. All right, I'm Don Rich, and you just experienced a Rich Insight. I hope you enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.